Welcome to Behavior and Risk, where we explore the intersection of decisions, the brain, uncertainty, and the business world. I'm John Burkhart.
And I'm Rich Loria.
We're glad you took a chance on us today.
Hi there. Welcome to another broadcast of Behavior and Risk. Today, we are going to be dealing with a unfortunately contemporary tragedy that is ongoing and evolving as we speak today. In images that have become far too common on our phones, television, and computer monitors, the old adage that Rome is burning has become a frightening and tragic reality for Los Angeles County residents. What was commonly believed to be a phenomenon isolated to the outlying exurban and rural areas of Los Angeles County has become something that has even impacted LA's most densely populated metropolitan regions. Multiple simultaneous fires that began with the Palisades conflagration on January 7th and quickly were followed by the Eaton fire on January 8th continue to rage on in some form. And only recently, the Hughes fire earlier this week began igniting and has already destroyed over 10,000 acres. It will be some time before the situation is satisfactorily contained. And I note here that even the Palisades fire, which is already over 2 weeks old, has still not been completely contained, despite the heroic efforts of so many of our public servants in this country. This is a tragedy that is just enormous, and I'm sure all of our listeners probably know at least one or more people. And for myself personally, I have a niece and her husband were evacuated, and they were among over 200,000 evacuations from that area, required evacuations. There has been repopulating that's been going on, but it is slow. And many lives will never be the same again. Many communities will never be able to fully recover. And certainly the whole area will look vastly different in the coming months and years.
It's a painful tragedy to watch. And I struggle because the scientist part of me looks at tragedies like this, and while my human brain is saying, this is horrible, what can we do to help? My scientist brain looks at things like this, like COVID, like flash floods, and can't help but pull out interesting behavioral extremes. Odd behavioral things happen in extreme events. And while this is a horrific event that is unfolding, series of events, really, there are some really important lessons, I think, that we need to look at and assess and understand, because as I think we're going to get into in, I don't know quite how far down the road here, but this looks like it's only going to keep happening. This is something that has happened in the Los Angeles metro in previous years, and by all apparent patterns, seems likely to continue to happen. So I think we need to ask ourselves, what can we learn about the nature of risk, about decisions of where to live and where to purchase homes and how to value homes, how and when to insure properties, and what parallels exist with other kinds of risk events?
I think those are all great points and great questions for us to consider today and for our audience to contemplate. Your point about this seems like something that has happened before. If it seems like it's happened before, it's because it has. Maybe not to this degree, but let's just say that there is a long-standing history of wildfires in that area. And in fact, Los Angeles County is among several counties in California that are designated as high wildfire risk areas. So to some extent, there really should be no surprise that something like this happened. I think what is really shocking and what makes this different from the many fires that have taken place over the previous decades is, one, the magnitude, the number of fires, the severity of them, and how much of the population has been impacted and dislocated. And what we can learn and what we talk about all the time in the ERM program at Columbia is that one of the hardest things to do is to consider the unimaginable. And I would offer up that I think some of what's going on here and some of the shock and dismay is because of our optimism, and that the optimism that people have about all of this and the narratives associated with that optimism have been shattered. And in some ways, I'd like to compare it to what happened on 9/11, which I know is an interesting comparison because that was a one-day event that was tragic in its own way. And on the other hand, killed a lot more people that, thankfully we haven't had that many deaths. I think we have on the latest count is somewhere in the neighborhood of 30 deaths across 2.5 weeks of fire in California. But I do want to talk a little bit about the 9/11 and why I think there is some behavioral comparison here, because I think back to the days before 9/11 happened and the ability to walk in and out of buildings without anybody checking you, without any type of ID requirements or anything like that. I remember in the building I was working in down at 28 Liberty that I could go all the way up to the floor of my office without any ID. And only when I got to the doors to enter that floor did I have to show ID. So you can imagine the amount of confidence and optimism that has to be implicit in the setup of such an arrangement. And that was shattered that day. Things changed, I would say, pretty permanently in terms of how security is viewed in a number of different elements of our society today that weren't that way back in the late 90s and so forth.
And so you're seeing a similar change in security, perception of risk or outcomes in wildfire or natural disaster events. How are
Well,
you?
well, the interesting thing is that, and I want to quote some statistics here, is that despite the number of wildfires, and if you look at the history of wildfires in the Los Angeles area over the last 10 years, there was one fire in 2016, three in 2017, one in 2018, one in 2019, one in 2020, one in 2022, and one towards the end of 2024, which was a bit of a harbinger for what's just happened here at the beginning of 2025. Now, the one thing I will say about all of the fires that have happened previously is that none of them were even close to this magnitude. Yet there were warnings. It's not as if we didn't know that this area didn't have the capability for a significant contagion event like what's unfortunately unfolding now.
There's that one particular fire in 2018 where there was about 1,100 or so buildings that were consumed in the conflagration. And prior to that, we really don't see anything that destroys more than 200 structures. And now, if we look across the three blazes that are currently going, we see there's more than 10,000 that have been consumed just in the last month, month and change. It is a truly precipitous calamity and something that is, to your point, I think, very much qualitatively and quantitatively different than anything that's happened before.
Yes. Again, we were talking before the podcast about if we were modeling out the past data, it has the feel of a relatively, I don't want to say benign, but certainly a modest compound Poisson kind of process we have here. And certainly something that's manageable with the existing tools. That's why, and we'll get to this shortly, that's why the insurance markets have only started to react. And what will be really interesting to see is the further reaction that comes out of this. Because if, again, going back to my 9/11 analogy, which may not be completely appropriate, one of the things that came out of it was the fact that terrorism became an exclusion from many policies and in fact led to a government regulated policy called TRIA because again nobody wanted to go back into these buildings, nobody wanted to put their people in harm's way in any big metro area without that kind of protection. So it will be interesting to see the fallout that happens in the markets, particularly in the insurance markets.
It's interesting because you and I display our own backgrounds and the biases that come with it because you think first, generally, in most situations, about the insurance aspect and the markets. And I think first about the consumers and the individual decision makers, just because those are the backgrounds we come from. You mentioned the optimism bias, and I'd like to hear more about your thinking about that regarding the insurance markets and how various organizations may look to that. But thinking about homeowners and consumers, optimism bias is a curious thing when we look at consumption because we've talked about this personally, you and I back and forth, that
Mhm.
optimism bias is a prerequisite for any sort of participation in the financial market. You do not participate in the stock market, in the bond market, in crypto if you do not suffer from optimism bias. That is to say, the expectation that things will work out better for you than it will for the typical person, that you are exceptional in some way and probability will favor you in a way that it does not favor the average person. I think it's fair to say that there's been a lot of optimism bias among homeowners, not just in California, but in the states in general. There has to be in order to dedicate that much of your income and your assets towards a purchase that large. You're not going to make that sort of purchase if you don't have an implicit or explicit belief that this house is going to be sound and whole in 15, 20 years. And that the value you've put into it, the value you've paid towards it, will continue to grow at a bare minimum, hold steady, and will not be burned up in a wildfire. There are some things about optimism bias and uncertainty and growing certainty that I want to talk about more when we get to the consumer side. But I want to hear more about your thoughts on the insurance market before we get into the consumers themselves.
So, what's interesting about the markets today is that wildfires are still an included peril in homeowners policies. And they are not, for the most part, excluded from policies. So people will get coverage. In fact, the estimates are that the overall insurance industry will take a hit of $20 billion from what's going on. That's the latest from JP Morgan Chase. That's their latest estimate on the ultimate damage. And again, we're not done yet because as I mentioned in my intro, we still have the issues going on with the Hughes fire, which is only, as of this date, about one-third contained. And that's burning at some rate. And there could easily be more damage. The numbers that you quoted earlier about structures impacted don't include anything from Hughes because right now we're still gathering that data. So it could be a much higher number. So this could wind up being easily a 25, 30 billion, who knows, kind of event, which is huge for the insurance industry. And not something that they're likely to continue to want to insure. And there's only a certain amount that you can try to get back through rates because one of the things about the insurance industry is that it's a highly regulated industry. Regulators sign off on rates that are filed in a given state, a given jurisdiction. And given the economic damage that's going on right now, I cannot imagine any regulator signing off on, I don't know, let's call it a number just for argument's sake, raising premiums by 150%, which would not be uncalled for given the losses that have been accumulating, plus any concern about future damage. Because it's not like these regions aren't going to become low wildfire risk because it's happened. It's not as if the climate's going to suddenly go back to being more temperate and less dry than it's been. So insurers, if they're going to play in the market, are going to try to get more rate and probably have some sort of limits. I think the best that can be hoped for in the market is that there won't be a complete exclusion of wildfires and that it's only a limit on damage. So maybe you only get part of your claim back. So if your home is worth, let's call it $500,000, maybe there's a cap of like 20% of that in order just to make this something that the insurers can play in. But again, that's not going to be sufficient for a homeowner. That's not going to make a homeowner feel good. So there's going to, in my opinion, we're going to be moving to where flood was, I don't know, 60, 70 years ago.
That's an interesting parallel because flood is, of course, the major, well known excluded peril that homeowners insurance just does not cover. There are very limited number of exceptions to that. There are some limited private market flood specific policies that are writable. And then there's the NFIP, which we're going to speak to probably in a bit here. But by and large, flood is an excluded peril for most policies. And my understanding has always been that the major reason flood is an excluded peril is that it's just impossible to price correctly. There's too much uncertainty around it. the events themselves are too irregular and there's too much volatility because your payouts are basically zero until there is a major flood, in which case your payouts are five orders of magnitude greater than what they would have been in a normal year. So it's just very difficult to price. I guess my question is what we're seeing in Los Angeles and California in general is a bit different, at least looking back over the last 10 years seems a bit different because we're seeing increasing regularity. We're seeing more frequent events, which means there's better data to aggregate to see what's the expected severity, what's the expected frequency. We also see that looking at when these wildfires occurred over the last 10 years, with one exception, they cluster pretty tightly between late fall and early winter. So there's a pretty strong periodicity in terms of what is expected wildfire season. And all of this speaks to, if not increased certainty, at least increased understanding of probabilities. So do you think that the magnitude alone would lead to an exclusion status, or would that just lead to cap on coverage?
I think what's happening now is a game changer.
Just too much in terms of
It's
damages?
too high a severity. So John, let's just rewind the clock, even back 1 year. So if you go back to the data and you try to price for expected wildfire damage, I'm pretty sure based on the existing data, you wouldn't capture it, even if you put a load on it. Because if you look at the numbers, there's nothing even approaching close. I mean, this is the equivalent of like a 10 sigma event, maybe 20 sigma. It's equivalent to runs on the bank. It's equivalent to what happened during the Lehman crisis, where the whole financial market just became stuck. This is the wildfire equivalent of that. And those are things that I can tell you as an actuary, you cannot price for or with any confidence. And one of the reasons you can't is one of your favorite terms that I'd like you to address here, which is that what we're dealing with is a variable baseline issue.
Sure, that makes sense. And it does seem to be a variable baseline issue. The variable baseline problem, for those of you who have not heard us discuss it before, is a fundamental problem in any sort of modeled system, which is that your model works great until it doesn't. Essentially, all models assume a particular set of inputs, a particular shape of computation and calculations. That is to say, they make numerical assumptions about what your background looks like, about what your baseline is, and then deviations are calculated against that baseline. Of course, once that baseline changes, once the emergent conditions in the world around you change sufficiently, your model is no longer valid. You can't apply it to anything that comes thereafter because the implicit assumptions and explicit assumptions in it no longer hold. And looking at the data we have going back 10 years, I think it's difficult to say at this point whether this is truly a variable baseline or a spike. I think probably next year, the next 2 to 3 years in particular, will be quite telling in terms of was this truly a unique event or is this a paradigm shift that we need to have a completely different set of predictions and responses for?
And the problem with that from the insurance standpoint is that we don't know the answer.
Yeah.
And if you stay in the market and you continue to provide the coverage you did before and you were wrong, you've got no chance of surviving.
This is an interesting point you raise about no chance of surviving. There's a topic I had written down to potentially address in this episode regarding survival pressures and altruism, and specifically in the context of homeowners. But I hadn't thought about it. Yes, it applies just as well to insurance entities, commercial entities of any shape, which is that your altruism and goodwill goes away once survival pressures come into play.
So there's a lot of really critical decisions for the private insurance market to make in the coming months and with the next renewal cycle. And what's really interesting about how the market was evolving is that State Farm appeared to be one of the prescient. It's almost as if they knew this was going to happen because in April 2024, State Farm announced that it had canceled a total of 72,000 policies in California, 30,000 of which were for private homes. And most of them were in upscale neighborhoods. Because one of the things that's come out of this whole crisis is that the fires really don't care what your socioeconomic status is. Fire is just going to keep burning, whether you've got, a 6 bedroom palace or it's a 2 bedroom ranch. It doesn't matter. And State Farm wound up canceling a lot of these policies that are in what has been classified as high risk neighborhoods. So I can only imagine that others will look at what State Farm avoided in terms of loss. And let's be clear, part of being successful in the insurance game is risk selection. And it's not always about the risks you select, it's about the ones that you do not select, that you reject for some criteria or underwriting reason that you've decided to exclude them. And very often that's the make or break between having a successful underwriting year and having a disastrous one. So I think, unfortunately, where the California homeowners insurance market is likely to go, we can take lessons from what has happened in places like Florida in dealing with flood risk and other high flood risk prone areas on the Gulf Coast. And as you alluded to, John, flood is specifically excluded from all homeowners policies. And the way that the government has addressed it is through the NFIP program, which is a voluntary program. And we've seen, unfortunately, behaviors that, again, go back to optimism and loss aversion and nobody wanting to spend unless they've experienced a flood or they see their neighbors experiencing a flood. And I can foresee something similar going on in California, where it's going to be more and more difficult to find affordable coverage if you can find it at all. And that the FAIR plan, which is currently a voluntary program, will become a bigger and bigger part of the market, but probably will still have a lot of folks avoiding it unless they have to buy the coverage. And that's going to typically be where homeowners are forced to buy it by the banks that they're borrowing from on their mortgage. That's what will be the key driver, which will limit uptake. By its own nature, that will have a ceiling because people are not going to want to pay the money. And typically with these government plans, and that's certainly the case with the FAIR plan from what I've studied about it, they don't cover as much as a traditional homeowner's policy, and you wind up paying more to have that peril included. So I foresee some of the same behaviors that we've talked about with NFIP emerging in the California real estate market.
I tend to think so as well. We've seen some very interesting patterns of homeowner choice in terms of who chooses to purchase NFIP policies or private sector policies for flood insurance in Florida and other flood risk map areas of the country. And there are particular patterns of uptake and rejection. And I suspect we're going to start seeing some very similar things in California. In terms of what we've seen in Florida of who does buy these flood insurance policies, as you alluded to, one of the most powerful drivers is perceived certainty. How sure are you that a flood event is going to happen? We know that generally speaking, when people aren't sure about the probability of an outcome, when they aren't sure what the correct choice is, they tend to not make any choice at all. This is the nature of the status quo bias. It's not actually a preference for the status quo. It's just a failure to reject the status quo because people aren't really sure what they should be doing. And so they do nothing at all. Of course, once it becomes very clear that you will actually have a flood or you will actually have a wildfire, your choice architecture shifts from uncertainty to certainty. And once we have certain losses, people definitely want to try to avoid them. People absolutely try to avoid losses. This is the nature of loss aversion. One of the more interesting asymmetries that has emerged in the Florida flood insurance market is in homestead. For those of you who are perhaps a bit younger than Rich and I, this may not pop on your radar, but many of us recall Homestead, Florida quite vividly from Hurricane Andrew, when it was absolutely devastated in the wake of this hurricane. Homestead, Florida's rate of flood insurance coverage is now 1 to 2 orders of magnitude greater than that of the rest of the state of Florida on average, because there is an enormous sense of certainty among residents of Homestead, Florida. They've lived through it. They know that floods are going to happen, and therefore they have flood insurance. I suspect we'll see much the same thing happening in the coming years in California in the wake of the wildfires, and especially if, as you suspect, Rich, the homeowners policies start to exclude wildfire from coverage or put caps on coverage. What I think will be very interesting to see is what will happen in the high value neighborhoods. One of the things that really has I found very interesting in looking at what neighborhoods have been hit and what has happened to the populations of these neighborhoods over the last few years is that unsurprisingly, when you think about it, there are huge asymmetries in home value in the Los Angeles metro. We have areas like, for example, Malibu, where median values are multiple millions of dollars. Whereas we have areas like, for example, San Fernando, where median values were less than a million. As you pointed out, the mandate for coverage for flood and likely emerging for fire is going to be through mortgages, through lenders who will then insist upon a policy being held. What will happen in these high value neighborhoods, which very likely are bought for cash? And we see a lower instance of mortgages. In these cases, are we going to see a lack of insurance, a lack of fire insurance? And if so, what are going to happen to the federal disaster relief claims? It's a really interesting question that I'm going to be tracking quite closely over the coming years.
Yes, and I wonder if we're going to see the same phenomenon in California with the wildfire risk and the uptake of either government policies or some type of protection that we've also seen with flood insurance, which has to do with socioeconomic factors.
Yeah.
So, as we know from data from the government, that the uptake tends to be higher among people with less means, with lower value homes on average than those who are more wealthy. And I wonder, given some of the high profile destructions, some celebrities have lost their homes, and this has been put out there on YouTube and elsewhere on the internet, whether we're going to see the same type of uptake going forward. We're going to see that disparity between those of lower means versus the more wealthy and well-to-do, or whether the more wealthy and well-to-do, because they associate themselves with these celebrities losing their homes, whether there's going to be a higher uptake there. I don't know the answer to that, and maybe, John, you might want to address that.
I would suspect we'll continue to see asymmetries there. You're correct that there is a greater percentage of uptake of flood insurance among lower socioeconomic status individuals. Normalizing for socioeconomic status, there is also an observed asymmetry in that African American and Hispanic American homeowners tend to purchase flood insurance policies at a higher rate than national averages. All of these, I think, speaks to the endowment effect. That is to say, the more effort and work you put in towards acquiring something, the more greatly you tend to value it. When we look at African American and Hispanic American communities, these are communities that historically have been marginalized and have been subject to greater loss. And so the endowed value of things that have been worked for and earned is going to be higher than that of the average American. And I think this is going to compound with some of what we're seeing in news reports. I will confess, I have no idea how frequent or how regular these are, but we've seen the reports of the private fire brigades that are coming into the wealthy communities and people who are putting out advertisements or pleas saying, I'll hire a firefighting brigade. I don't care what the cost is. Please come in to save my neighborhood. I think that lower socioeconomic status individuals are going to probably see this and realize that nobody is coming to help them. And so an insurance policy is absolutely the correct choice to make.
And I also wonder, in terms of the intertemporal or time aspect of all of this, whether we'll see a similar phenomenon with what happened in Homestead.
Hmm. Over the next 5, 10, 20 years?
In terms of the next 5, 10 years, in part because I think one of the things we've talked about with regards to NFIP and some of the reasons for the relatively low uptake overall on NFIP is the perception that federal disaster funds will come in and make everything okay. And it's only when you go through the disaster and have the experience of having to wait an extended amount of time to get ample help that you realize, oh, if I had only had the insurance policy to begin with, this would have been resolved a lot sooner. Now, I do expect that it's going to take a while to work out these 20 billion or so of claims that the insurance industry is going to pay out, but I think it's going to be much longer before any sort of federal disaster funds beyond those that have already been granted by former President Biden And by the way, what former President Biden is doing is basically a band-aid on a giant gashing wound in terms of the amount of money. So I wonder if there's a similar experience in terms of what I would anticipate to be an extended wait for federal funds, whether that has an impact on insurance uptake going forward, where you can get the insurance.
I would suspect we'll see parallels there with what we've seen in Florida and the southeastern United States when it comes to flood coverage. As you pointed out, federal disaster relief is a curious beast because there is a perception among many homeowners that why would I get a flood insurance policy when I can get federal disaster relief, when anybody can get federal disaster relief? And this is objectively correct, but that doesn't state when you'll get federal disaster relief, and it doesn't state how much federal disaster relief you'll receive. When we have sparse intermittent events, where, for example, if we're looking at the wildfires, where in previous years there have been, I'm just reading down the list here, 10 structures destroyed, 123 structures, 6 structures, 19 structures. It's very easy to look at that if you're not somebody who was affected and say federal disaster relief, not an issue. Now, when we have 10,000 plus structures destroyed, and federal disaster relief is absolutely going to run out of money very quickly in this. And if you have been waiting on it or expecting it, it will take 6 plus months, and you're not going to receive your full home value. You're going to receive, I'm not even sure how much, tens of thousands of dollars. I don't think anybody's going to get 500,000 or more for certain. You get an enormous level of what is called prediction error. This is a learning signal in the brain as to what happens relative to what you expected to happen. And I think this ties in very directly to your assumption, your correct assumption, I would assert, that much like we saw in Homestead, in the next 10 to 15 years, people in Los Angeles will purchase far more fire insurance policies and these federal FAIR plans simply because they will have seen what happens if they rely on federal disaster relief alone.
I would anticipate this is a buying opportunity.
Yeah.
It's going to be likely that people are going to be reluctant to get back in the water. Well, back in the fire, maybe is the better term here. And that there could be real buying opportunities and real chances for construction profits, investment opportunities for folks.
I tend to agree, but I think this is not a single family buyer's opportunity. This is a developer's
Oh,
buyer
yeah.
opportunity. I think that most of those who would be in the market tragically probably have most of their savings and assets wiped out. They have
Yeah.
limited or
Yeah.
non-existent ability to buy into this. So yes, I think we're probably going to see huge swaths of the affected areas bought up at, well, if you'll pardon the pun, a fire sale price. Um, for by developers and construction companies. And what emerges, whether it's commercial property, probably multifamily home developments, and what happens to the prices thereafter, that remains to be seen. We know that nationally, excluding any consideration of natural disasters, there is a housing crunch, that people need more and more housing and prices are going up. A malicious interpretation, or perhaps cynical interpretation, would be that this is a really good opportunity for a handful of developers to corner the market and essentially price fix and artificially increase prices because they're not going to compete with themselves. Whether or not that happens, remains to be seen. I confess an ignorance of California real estate laws, whether there are protections for fires and renters, but the less charitable part of me suspects that this is not going to be good for home buyers or home renters on top of the fires that have already not been good for them.
Okay, so let me build on that with regards to the individuals and going back to the time domain. Do you see that the time domain will work going with the arrow going towards the future, and that over time people will tend to forget or maybe put things in a somewhat different light? And again, a lot of it will depend on the experience, but let's just hypothetically say that over the next 5 years, that nothing of this scale happens again. And God forbid, let's hope that's what turns out to pass, that we don't see anything anywhere close to what we've seen over the last 3 weeks. Do you think people will say, hey, you know what? Here's an opportunity. I've always wanted to live in, say, Malibu or Palisades, and there's an opportunity here. And it's a really beautiful home. We've been fortunate in terms of our income. We can afford it. Let's go for it. I know the history, but that was 5 years ago.
So this is an interesting question, and it depends on, I think, a lot of different things. It depends, of course, on do we see another major fire next year? If we get two in a row, that's going to stick in everybody's minds. One of the things that we need to keep in mind here is almost by definition, the sort of buyer that you just described is not somebody from the area. It's not somebody who has immediate experience with it because most of the people who've been through this, either their homes have been preserved and they are not probably looking to buy anything in the near future, or their homes have been destroyed and they either are wiped out or in very difficult financial circumstances, or if they are not wiped out, probably have some adverse memories and experiences associated with this region and will probably be looking to purchase elsewhere. So, the overwhelming majority of people who will be coming into these burned out areas in the next 2 to 5 years, let's say, are either people from unaffected areas of Los Angeles Metro or people coming from outside the state entirely, who, to your point, has just have had the idea in their head of Malibu, Santa Monica, Palisades, or areas that they would want to live. These individuals are absolutely going to be subject to that short memory, to that lack of salience, as we would say, that lack of availability. They don't have that firsthand, personal, visceral experience with these natural disaster events, floods in Florida, wildfires in Los Angeles. And so they are more likely, I would predict, to be willing to buy these homes or rent them or move into these affected areas. The caveat to that is, again, if we do happen to see more and more fires occurring over the next year, 2 years, 3 years, it will take some time to develop these burned areas and repopulate them or redevelop the homes on those lands. So I think probably the most conservative timescale will be probably 2 years, where we could expect to see large scale migration into these areas. If there's another major wildfire next year, I would expect the predicted value on those units is going to go down quite precipitously. Now, where this gets even more confounded is something that I read just in passing earlier today, and I will confess I have no idea where this is going to go, but it has been part of federal policy going back to the early days of the 1900s to not permit controlled burns. That is to say, small scale intentional fires to clear away collected brush in any federal landscapes. And there is reconsideration of this policy moving forward. There is some reconsideration that maybe we should be doing controlled burns. It was pointed out that this was something that was done by the Native American tribes for centuries prior to the settling of California and the West Coast in the 18 and 1900s. If this policy is reinstated and we do start to see a lessening of wildfire events, then yes, I think the housing values of novel properties, of newly built properties, and the willingness of people from outside the area to pay for them will absolutely increase.
Interesting. So this gets to the issue of risk appetite.
Sure.
Okay, so we've talked about risk appetite in previous podcasts and in other domains. And just for everybody's benefit, a reminder that risk appetite consists of perception and preference. So my question to you, given what you've just stated about the potential behavior that could play out over the next few years, do you see any migration back as being more of a preference? Do you see these folks as being more risk positive? Or do you see them as just, again, more of a perception issue? You kind of implied that maybe their perception of the events that are currently going on might be in some way not as visceral as those who live in the area.
I think that risk preference is not really worthy of consideration in this particular conversation simply because two elements. One, you're always going to have borderline insane people who have very high risk preferences and who will do anything because they just don't care. These individuals, it doesn't really matter what the facts on the ground are. This is a very small population, however. The other dimension of risk preference and why it's not really a factor is because when we look at the overall population of the United States and compare that to what is the total population that we're looking at to repopulate these areas that have been affected by fires over the last 2, 3 years, there will always be enough. There will always be enough people open to migration, no matter what the level of risk preference is, just because even if you do require a 2 sigma deviation from the national average of risk preference, we're looking at a US population of what, 340 million people? You can find those 20,000 people or so you'll need to repopulate Palisades or Brentwood.
Mm,
It's not going to be an issue. So I think most of what we're going to be seeing in terms of risk appetite dynamics and which element most influences it is going to be risk perception. What is the level of surety of risk? How confident are people that a wildfire event will happen or will not happen? And if it does happen, will affect them or not affect them? This is going to be affected by lots of different elements. As we said, another major wildfire event next year or a continuation of this. If right now, as you and I are recording this, it is January 24th, if another blaze sparks up next week and burns another 5,000 homes, all of a sudden the appeal of new homes in the Los Angeles metro drops precipitously. And then if this happens again next year, this becomes an even more powerful limiter of appetite. But if we do see that there are no further, or at least only limited wildfires in the next 2 years or so, and there is a very good PR campaign on the part of California and Los Angeles about safety measures that have been put into place, whether or not they actually have been, as long as they're communicated well. This gets to this whole topic of risk messaging, which is its own podcast. That then contributes to a increased perception of safety and a lower perception of risk. In this
mm.
case, then the net impact is an increase in risk appetite because of a perception of lower probabilities.
Yeah, I would tend to agree with you. Your point about the number of folks and where they can sit on the risk preference curve, I hadn't ever thought of it that way, but you're absolutely right. I mean, if you just have a number of folks who either don't care or who tend to veer towards that risk positive part of the overall distribution of risk preferences, then yeah, you can find enough people who would be willing to go there and willing to take that risk. And that if the area does go through a period of time where there's relatively what I'll call benign activity. So I think even if things go back to the way they were for the previous 10 years, again, there were no events that got completely so out of control that there was huge damage. I think you mentioned one of the events had something like 1,000 structures. I mean,
Yeah, 2018.
yeah, that seems like a super benign event compared to what's going on now.
And
So
this creates a really interesting impact in terms of your comment on the variable baseline and how that will interact with future risk perceptions. Any future event that consumes less than 500 homes isn't going to make the nightly news.
no, it's going to be just part of the background of living in that area. Just to wrap up here, this again is an evolving situation. And certainly we had to think carefully about when we recorded this, but we feel like this is a good time. This has been going on, unfortunately, for a couple of weeks. And hopefully it will also be something that is contained completely or close to completely very soon. Our hearts and our prayers go out to all of those who've been affected. And we certainly hope that the conditions improve and that the greater Los Angeles area is able to recover and thrive once again in the near future. Thank you.
Behavior and Risk is brought to you by Capita Solutions. Behavior and Risk staff includes our research team, Sherry Xu and Jin Zhang, and our editing team, Qingying Gao and Athena Liu. Theme music by Crypt of Insomnia. The opinions presented here are solely those of John Burkhart and Rich Loria and do not represent those of Columbia University, Capita Solutions, or any other organization. We thank you for taking a chance on us today.